This guy is worth $6.7 billion. He amassed most of that with trading. And so in today's video, we're going to be taking one of his principles and breaking it down and showing you why it is so unbelievably valuable in trading, because it's going to help us to understand exactly what tools are good, what tools are bad, and specifically how to use the tool that I'm going to be showing you today. So this is the diagram right here. Now let's just go through it left to right and break it down step by step. So basically, let's just say we have a neutral market during this period, which is basically what this is representing, and prices begin to go up. Now what happens here? Well, for most people, there's going to be one of two categories. You're going to have category one, which is people who are going to always be looking for the breakout, right? Then you have category two of people who are trying to fade the move. What does that mean? Well, as prices go higher, they're going to be the mean reversion traders. As we begin moving higher, the breakout traders are going to be doing well, and they're going to continue riding it up, most likely. And then group two are going to be hurting. These are the people that are going to be struggling a little bit during this sort of a period, because this diagram doesn't emphasize these consolidation periods right here, assuming that they are consolidations. But just imagine that mean reversion works well in this environment and trend following works well in this environment, of course. But what will happen is both sides will end up aligning with the original direction of the breakout trader. So as prices begin to move, let's first of all start with the mean reversion traders. Let's just say they're selling into this, they're getting stopped out, they're selling into it, they're getting stopped out. There's going to come a point where they've lost enough times where they're going to start to think, oh God, man, it's becoming so obvious the prices are going up. I think I might just switch to the upside. And so if we think about human beings as a crowd, what will eventually happen is we will reach what I like to call an inflection point. Now, this inflection point is just a fancy way of saying that even people who were net short are going to reach a point where they're like, Jesus Christ, I can't still come to a logical conclusion that this is going to go down. Everything is going, it's massively extreme. Like, I don't know what I'm doing. Now, this is all fueled particularly by people who only trade with technical analysis, but it also happens with fundamentals. Why? Because prices are very visual. If you're seeing markets just rocketing up, it's very hard psychologically to ignore the fact that you've got something right in front of you that is rocketing up really aggressively. Now, why is this important? Because at this point, the way that sentiment interacts with the market changes. Now, what the hell does that mean? Well, sentiment is basically the attitude towards the market. Now, there are tools right here. Let me just get rid of these right here, which we're going to show, and I'm going to show you how this represents everything else, because retail sentiment, which is what this is, but I particularly like this one, is so valuable, but most people use it wrong. Oh, most retail traders are short, therefore I want to be long. That's the wrong way to use it, in my opinion. So what is the right way? Well, if we think about it again and we go along this journey, once we've reached this inflection point, those original camps that we spoke about where we had breakout traders, which I'm just going to kind of say / trend traders here, which will be B/T, and then the second group, which are going to be the faders / the mean reversion traders, which is F and M. Now, what this often leads to is it leads to essentially the greed stage. All of the retail traders are aligned. In other words, they are desperately following that prevailing trend. It's so obvious what the current momentum is. People are just trading it, and they're trading it because they think it's going to go on forever. This is human psychology. In reality, what typically tends to happen is as follows. If I just delete this diagram. Okay, so if we imagine here that we have a normal market, let's just say there is a general trend up. In reality, that trend could just be moving like this. One of the big reasons it doesn't, not the only reason, but one of the big reasons it doesn't, is just because of how humans work. We tend to overreact on the up and overreact on the down. We exhibit herd-like behavior. Now, this is what George Soros, which is who this man is talking about with this principle. It's the idea of humans to overreact in different proportions. And if we understand this, this becomes a really valuable tool for us, because what this is showing you is it's showing you week on week or day on day the percentage of people that are net long with this particular broker, and it's also showing you the change in longs and shorts, which is what we're going to get onto in a minute. But it's showing you basically who's net long. So if we see, for example, Euro USD right now, 66% of retail traders with this broker are net short. But the problem is that if you look at this in isolation, if you just look at it and say, oh, well, 66% are net short and I want to go against retail traders, that doesn't take into account whether you're in the right environment to use that indicator in this way, where we are within this cycle because it changes how we interpret the retail sentiment. So that might have been a lot of words. So let's just break it down. Let's first of all start about what we would typically see in a greed stage. Well, if every trader is aligned to one direction, what are we most likely to see on a sentiment indicator? Well, we're likely to see, let's just say they're all aligned to the upside, we're likely to see something like this. We have 88% of people that are net long on the currency because most people are agreeing. Now, at some point, right, this is going to be where contrarian indicators work the best, where looking at retail sentiment as contrarian is a really, really good indication that something might be beginning to change. Now, this is something I want to preface is this is not on its own a strategy. This is a great way to get the bias and get an idea of how to use it. But for the opposite side, let's just look at when we're in the middle. So when we're in the enthusiasm stage. At this point, just before the inflection point, what is going to be going on in retail traders' head? Well, think about it. If we've got those two categories from earlier, we've got basically trend followers, and then we've got mean reversion traders. This group are going to be happy, and this group are going to be sad. So even though market prices are going to be going specifically in one direction, there's not going to be a crazy input that retail sentiment is going to tell us, because there are always going to be these two groups, and there are going to be lots of other groups that are, maybe more complicated types of trading. But by and large, people are either trying to fade things back to an average or they're trying to ride the momentum. So what is the key difference? When we start seeing dramatic changes, so if we just go to the weekly here, this shows change in positions weekly. So if we look at this in the biggest ones possible, okay, we can see that Euro GBP in the last week, the longs have been reduced by 56% and the shorts have increased by 38%. Now, if you were just looking at the net long and net short, you'd probably look at this and be like, oh, it's kind of neutral, right? Because we've got 46%, we've got 54% here. Like there's not that big of a difference. Most people are going to sort it by something like this. They're going to be like, oh my God, silver, like this looks really bearish, right? That's not really what we want to be looking for, because we see that this huge change has happened. Now, why is that significant? Well, if we go to Euro GBP, which is what we're on here, what do we see? How are we behaving in price? So if we go to the weekly chart, what happened by the end of last week? Undeniable aggressive movement in price. Undeniable. Now, because we've had that undeniable movement, is it really surprising that we're meeting this greed stage right here? Now, does this mean that the market is going to turn around at this exact point? No, we don't know. Which is why, like I said, this isn't a full strategy, but this is a really good indication of what might be beginning to happen. Because then if we just look at the technicals and we go, okay, well, if we see evidence that we, for example, are going to really confidently break through a low, whether it's this low, whether it, goes up here and forms another low and then breaks that one. If we have a strong break of a level, we return to it, or maybe even we don't, maybe you're a breakout trader, that's fine. That could be an indication that we may be beginning to shift around. Now, if you want to take this to the next level as well, you can add in certain kinds of fundamental biases and stuff like this, which is actually really simple. I think people really overcomplicate that. And then the technical side of it as well, there's lots of things you can do to add confluence. That's not the point of this video. The point is to show you that this is not that helpful unless you are looking at it in the context of the overreactions of traders to the market, because that is going to indicate when things are beginning to shift. And looking at the changes in is going to be one of the key ways that we do this. Now, if you'd like some more information on how to do this, because I'm making a whole new training for the program on this exact topic, as well as many others, and how I'm combining everything together to gain some actual, basically institutional biases in the market, rather than just saying, oh, prices are going up, therefore I'm going up, or I'm going down, then I'd highly recommend that you join our program. Okay, we do have a systematic system, which means the actual strategy is very easy, but it allows us to focus on the other elements of trading, such as how to improve, how to measure your progress, which doesn't sound very sexy, obviously, but it is sexy because I prefer to do well and have a slightly less sexy process than have a really sexy strategy and not do well. Anyway, guys, I hope you've enjoyed this. I'll see you in the next video. I'll leave a video up here right now you can go check out. I'm sure you'll enjoy if you enjoyed this one. Take care.